Cheers, mate. Hello everyone, I hope you've had an enjoyable morning and have learnt some new things. So I'm here to talk to you today about 3 active ideas to invest for income. Now my role in BetaShares, I work as an Associate Director in Advisor Business, so I spend the majority of my time out talking to advisors but also investors like yourself on how they're actually constructing their portfolio for the goal or objective they're looking to get out of that. And I guess one of those key things, of course, that comes up a lot is how do I generate income? Because it's not as easy as you think. So before I get into the ideas around using BetaShares and our Legg Mason actively managed funds, just to give you a little bit of background and introduction into BetaShares and also Legg Mason. We partnered with Legg Mason about a year ago to launch the first or 2 of our actively managed income-focused ETFs in equity income and real income. And more recently, as of last week, we launched the first actively managed Australian bonds ETF in the market. So, and a very exciting development there for your fixed income portion of the portfolio. The reason we chose Legg Mason to partner with in terms of these active income strategies is the fact that they are a global leading fund manager. They manage around $1 trillion of funds. 55 billion of that is based here in Australia. They're an active pure play manager, and they're also very highly rated. I think of the last 4 years, they've won Fund Manager of the Year here in Australia. So let's get there. In terms of BetaShares, who are we? Well, we are also an award-winning leading ETF fund manager. We manage around $6 billion, and that's across 51 different funds. So we're offering a very broad range of ETF investments that you can access through the ASX. So if income is your goal, you can tap into that goal through our ETF solutions. I will not bore you with too much information about myself. You will notice there, though, that I have partaken in Movember this month and also the handsome gentleman out the back there too. So 2 more days left, so we're still taking sponsorship money if anyone wants to throw some coin our way. My partner is very much looking forward to me not looking like this. Meeting the needs of the income investor. What are some of the struggles or what are some of the things that you as an Australian investor face when you're trying to generate income from your portfolio? Well, the first problem that I hear is that accumulation products don't necessarily focus on income generation. That's pretty self-explanatory. They're looking for growth, alpha. They're not making active tilts to companies that are going to give you growing, sustainable income. The next 2 points, traditional products often focus on capital volatility rather than income volatility. What are we saying there? And this is actually a very, very key focus of 2 of the funds I'm going to be talking about today in terms of the equity and real income fund managed by Martin Curry. Capital volatility, you don't want to see a lot of capital volatility as an investor, of course. You want that capital preservation. But if income is your focus, how can you budget on when your income's doing this? You need to know exactly, or to a certain extent, what that income's going to look like quarterly, 6 monthly, or annually. So ensuring that that income volatility maintains or is low too. And equity benchmarks can lead to income shocks. And why that is because a broad market like Australia, 7 of the 200 companies make up just over half the income that you do actually earn. So around 3% of that's captured by those top 7. So if you have things like income shocks like BHP, 2016, cut their dividends, that was a meaningful change to what you as an investor got paid. Or more recently, Telstra, another dividend trap, which obviously had another meaningful change to what you got paid. If you're invested in a broad benchmark, you have no way of avoiding that. High capital volatility relative to bonds, simply saying if you're invested in equity, you've got to take that volatility, but is there a way you can do it through an actively managed strategy that's going to give you that smoother ride? So here are the ideas. Equity income or real assets, and also fixed income. All 3 are key parts of a well-diversified portfolio and 3 key asset classes. So you should be looking at generating income, not from 1 or 2, but all 3 of these. And here are the funds that I'm going to be referencing to in terms of those ideas and those strategies around those 3 asset classes. The first 2, the Equity Income Fund, EINC, And the Real Income Fund are actively managed strategies by Martin Currie, which is an affiliate of Legg Mason. Grossed up forecasted yield of 7.9% for the Equity Income Fund, 6.1% for the Real Income Fund. And these funds are looking to give you a broad, diversified exposure into quality companies that, again, have that future outlook in terms of growing dividend streams, not so much looking historically what they've paid. The Equity Income Fund, it's looking at income yield above the ASX after tax, whereas the Real Income Fund is looking to generate equity income yield above the broad market ASX 200 before tax. And they also have inflation in mind, so growing that income above inflation, so ensuring that you're keeping your purchasing power there. Our newly listed fund, BNDS, is, again, as I noted, is the first actively managed bond fund that you can now access through the ASX. This is managed by Western Asset, who are a global leading fixed income manager. Now, of that $1 trillion that Legg Mason manages, these guys at Western Asset make up about $600 billion of that. And all their funds, the unlisted version that's sitting behind this, are very highly rated and recommended by Australian and global research houses. Why is income so important? Well, accumulation phase, understandably, income's probably not on the forefront of their mind. They can take the volatility or the guy jumping over on the jet ski there because they've got those long-term growth prospects, so they can take those movements in the markets. Whereas when in retirement, you want regular, reliable, consistent income that you can bank on because you are budgeting around that. So you want that smoother ride, that nice little trundle up the 18th, 5Ks an hour in your golf buggy there. So it's got a minimal capital volatility, minimal income volatility, and you've got to maintain your purchasing power, so that protection from inflation. So the first idea is equity income, and that's in relation to that E-Inc fund, which is managed by Martin Currie. What are the type of characteristics of this fund? He holds around 40 to 45 companies based on what he's done in the past. He's looking at high yield, but if you look at just high yielding companies, what happens? BHP, Telstra, you need to look at other metrics. So he's looking for higher or quality companies that have that growing, sustainable income on a forward-looking basis. And because he's looking at those quality companies, a byproduct of that is going to have lower volatility. So he's giving you that smoother ride in the market. Strong focus on growing income streams, straight to that point, looking forward, not backwards. Simple investment strategy and tax efficient. You as an investor have to understand it, and he's looking to utilise franking credits while they're still here, in that investment strategy, so you can access that through the EINC fund. The next slide is a really important one, and it talks to that point I made earlier around income shocks. You can see two companies that I've already mentioned in terms of what happens when there's a meaningful change to that business. You as the end investor don't get as paid as much. That affects the lifestyle that you want to live. And if you are invested in a broad index, you have no control of that. So what Martin Currie and his team are looking to do is not only invest in those quality companies, but looking to diversify the income, as we can see on the right here. You get a smoother, more diversified income stream from those companies. So not one company is taking up a large portion of that, so avoiding those income shocks. The second idea, another equity investment idea, but slightly different. You're investing in real asset, hard assets. The investment strategy itself follows very much as the previous one. Sustainable income growing above inflation, investing in quality companies, giving you that smoother ride and that lower volatility. Australian focused. There's only two companies that currently sit in the portfolio, which are dual listed with New Zealand in here. And this is a real key point, lower concentration risk to AREITs, Australian Real Estate Trusts. A lot of people invest in infrastructure or the AREITs market, but again, what you're getting in that when you look under the hood is a lot of stock concentration with 2 or 3 companies. Westfield Centre Group makes up about 50% of that. So if there's a meaningful change to that company, that means you will be negatively affected. And where's the value of these companies really, or value of the assets these guys hold, or these companies hold? A service-based industry like an accounting firm, the value of that company is really derived from the work that people do in it. Whereas you look at real hard assets like this, the value to the business is the asset itself. So it's usually a large asset, a long-term asset, and also there's usually a regulated asset as well. So as inflation increases, these type of assets usually get to pass that on to the end user, which unfortunately is us. So what are they invested in? Office buildings, shopping malls, toll roads, gas and electricity grids. And the performance of these type of companies are more tied to population growth more than an economic cycle or a business cycle. And the reason for that is no matter what's happening in the wider world or in our domestic economy, you as a person are still going to get up in the morning, you're going to turn on your light, you're going to hop in your car, and you're going to drive to work, and then you're going to go to a mall and buy shopping or clothes for your family. So these things just go on no matter what else is happening in the world. So as more people use these types of services or these assets, you as an Australian investor are going to benefit from that. And why would you want to be tied to population as your performance metric as investing in real assets? That's why. Australia has a higher expected growth or population growth than any other country in the world. So not too bad, really. So you can access this, this through the ASX again. It's currently yielding that 6.1. And another real, I guess, key thing to look at or think about is if Labor gets in and franking credits are something of the past, how would this affect a fund like this? And because it's diversified, 50% within A-REITs, 50% across infrastructure and utilities, there's only about a 20% or 20 basis point difference between the unfranked and fully franked. So 6.1 turns into 5.9. So you're kind of hedging against another income shock in terms of a regulatory change. The third, and this is, as I mentioned, a real exciting development for people that are looking to construct their portfolio using ETFs because it's the first actively managed Australian bonds fund or fixed income fund in the market. And I guess from what the other speakers have been talking about today about the importance of fixed income and how it's often an asset class that's usually not quite looked at or not quite understood. So giving you an option to invest through an ETF as easy through the ASX and also using the expertise and skills of Western Asset to be able to give you a diversified exposure. Currently there's around 437 bonds sitting in the fund from the top of my head. Strong risk management focus. So they're looking to utilise their expertise in around judging the market cycle, being able to pull those different levers through active management, risk, interest rate duration, credit duration, and sector exposures. Embracing bond market development. All we're saying there is there are more bond issuers or global issuers looking to issue bonds in Australia. And because Western Asset is a global fixed income manager, it gives them the ability to understand those companies that are issuing those bonds in the country that they originate from. So from a ground level, they get to understand the risks and the benefits instead of trying to do it in a sort of satellite office here in Australia. An experienced and award-winning team. They're one of the top-rated fixed income managers. What is the fund giving you? Well, it's giving you a more diversified exposure. As you can see here, a lot of investors will take a broad benchmark exposure like the Ausbond Composite. But really what you're tying yourself to when you're investing in something like that is the funding needs of the federal government. 70 or over 70% tied into that. What's another downside of that? It doesn't give you much yield enhancement. Whereas when you look at the active management strategy of being able to evaluate each issuance, where that is in the business or economic cycle, and give you a better adjusted yield enhancement and more of a tilt to corporate investment grade bonds, you're getting a better yield pickup, and that's currently yielding around 3.7 on a running yield basis. So quick checklist, what do you as an income-orientated investor need? You need regular, reliable, and consistent income. You need protection from inflation. So like the equity income fund and the real income fund, inflation is another thing that is front of mind for those portfolio managers. Asset allocation is key. Don't try and get all your income from one part of your portfolio. It has to be diversified. And diversification, not just at an asset allocation level, but you've got to look under the hood. What is in that exposure? Where is the income coming from? Is it one, two, or a handful of stocks? Could I be opened up to a dividend trap or some income shock? active management. Active management is going to avoid those. Those quality companies are going to have that future view on where those income streams are coming from. Compliance side, of course, we've always got to have this one, so feel free to read that now. But what we're really getting to today is you can now access these active strategies and these asset classes through these funds. The equity income fund at a grossed up forecast yield of 7.9. Our real income fund, again managed by Martin Curry, at 6.1 forecasted yield. And finally, our new released active Australian fixed income fund through BNDS with a running yield of 3.7. So we've already had a lot of you come up to our stand today, and thank you very much for that. But please come up and ask myself and the two gents out the back any questions. But hope you enjoy the rest of your day.